What are REITs and how do they work? A beginner's guide. Have you ever wondered how people can invest in real estate without having to buy a house or an apartment building? Imagine if you could own a tiny piece of a huge shopping mall or office building and earn money from it without having to worry about fixing leaks or dealing with tenants. That's where something called REITs, or real estate investment trusts, comes in. REITs are special kinds of companies that own, manage, or finance real estate. They make it possible for regular people like you and me to invest in large-scale real estate projects. Things like office buildings, hospitals, hotels, or even shopping centers, without actually buying any property ourselves. What exactly is a REIT? At the most basic level, a REIT is a company that owns and manages a lot of different kinds of real estate. But the thing that makes REITs really cool is that they let anyone invest in them, just like you might invest in a stock or a bond. When you invest in a REIT, you're buying shares of the company, and in return, you get a chance to earn money from the properties they own. Think about it like this. Let's say you and your friends decide to pool your money together to buy a big pizza. You all chip in a little bit, and when the pizza arrives, everyone gets a slice. Each slice represents your share of the pizza. With REITs, you and many other people can pool your money to own a piece of a big building or a group of buildings. The more money the buildings make through rent or property sales, the more money you can earn. The types of REITs. There are several types of REITs, but most of them fall into one of two categories: equity REITs and mortgage REITs. These two are the most common, and the ones you'll likely hear about when people talk about REIT investing. 1. Equity REITs. These REITs focus on buying and owning real estate. They collect rent from tenants who use the buildings they own, whether it's office space, apartments, or retail stores. The money they make from rent is passed on to investors in the form of dividends. If a company owns a large office building and rents out space to businesses, the rent money collected is shared with people who own shares in the REIT. Equity REITs are the most popular type of REITs because they are tied directly to the value of the property itself. The better the property does, the more rent it can collect, and the more money investors can make. 2. Mortgage REITs. These REITs don't buy the buildings themselves. Instead, they provide loans to people or companies who want to buy real estate. So, a mortgage REIT might lend money to someone who is trying to build an apartment complex. In return, they earn interest from the loan. Mortgage REITs make their money from the interest paid on these loans, and they also pay out a portion of that income to investors. How do REITs make money? Now, you might be asking, how do these companies actually make money? It all comes down to property and how it earns money. When REITs own real estate, they make money in a few ways. Rent, as we mentioned earlier, most REITs own properties that they rent out to people or companies. The businesses or people renting the property pay monthly rent, and that rent is a source of income for the REIT. For example, an office building might have several businesses renting space. The rent they pay helps the REIT make money. Selling properties. Sometimes, REITs decide to sell a property they own. If they sell it for more money than they paid for it, they make a profit. That profit can be used to pay investors or reinvested into other real estate. Loans and financing. If a REIT is a mortgage REIT, they make money from the interest on loans they provide for buying real estate. Mortgage REITs help finance the real estate industry by providing loans to others who want to buy or build properties. They charge interest on these loans and earn money from that interest. How do you invest in a REIT? Investing in a REIT is pretty simple, and it's a lot like buying shares of a company. REITs are listed on stock exchanges just like regular companies, so you can buy shares of them through a brokerage account. If you already have an account to buy stocks, you're ready to start investing in REITs. Once you buy shares of a REIT, you essentially own a small part of the real estate that REIT controls. The nice part about REITs is that they pay dividends, usually every quarter, so you get regular payments as a reward for your investment. These payments are made from the money the REIT makes from renting out properties or other income sources. Since REITs are required by law to give at least 90% of their taxable income to shareholders, they tend to have high dividend yields. This means you could earn money regularly from your investment, even if the value of the REIT itself doesn't increase right away. Who should invest in REITs? REITs are great for people who want to invest in real estate, but don't want the hassle of actually owning physical property. Maybe you don't have enough money to buy a big building, or maybe you don't want to deal with the responsibility of being a landlord. With REITs, you can still benefit from the real estate market without having to do any of the heavy lifting. They're also ideal for people looking for a steady income from dividends. Since REITs pay out most of their income to shareholders, they can be an attractive option for people who want regular cash flow, such as retirees. If you're someone who likes the idea of owning real estate, but doesn't want to deal with managing tenants or dealing with repairs, then investing in REITs might be the right fit for you. The next time someone mentions REITs, you'll understand exactly how they work. But there's so much more to explore when it comes to investing in these real estate giants. Whether you're interested in the best REITs to buy this year, how they compare to other investments, or what the risks are. There's a lot more to discover on your journey into the world of REITs.